We are then going to calculate the adjusted PE multiple. Let's go back to the steps that I provided you with. Now, please remember, guys, we are looking for the PE multiple of a similar listed company. Now, either the multiple will be given to you or you will have to perform the calculation. If you have to calculate the multiple, very simple calculation. We take our price or the value of equity and we divide by our earnings. And please note you are using diluted headline earnings in this calculation. Now, the logic behind why we use headline earnings is because headline earnings better reflect the trading or the operating activities of the company. So any unusual items or anything that is not operating in nature has been excluded. And remember again, your earnings figure must always be comparable to the multiple. So in step 1, when we calculated maintainable earnings, we looked at earnings that relate to the main business operations. If there was anything that was not operating in nature, we excluded that. So we had dividends on a listed investment which we excluded because the investment is not operating in nature and will value the investment separately. So if we've made that adjustment to our maintainable earnings, then the multiple should also only reflect the trading or the operating activities of the company. Also, this multiple is after interest and tax, and in step 1, when we calculated maintainable earnings, that was also after interest and tax. So operating or trading items are those that reflect performance in the current period that can be extrapolated into the future, because we are trying to predict earnings that can be maintainable in the future. So we use the same earnings figure when we are calculating the PE multiple of a similar listed company. Then, we can't just take that multiple and use it as it is. You can see in the heading, we are working with an adjusted PE multiple. And that's because there are going to be differences between the listed company and the company that we are valuing. And we now need to adjust for those differences. So below you can see where an unlisted business is being valued, the PE multiple of a similar listed company is used and is adjusted for entity level differences between the companies. So right now we are looking at the entity level differences. So you'll remember at the start of our lecture, I said to you, these entity level premiums and discounts, we are going to make these adjustments to the multiple, the WACC, or the cost of equity. So either you are given the PE multiple of a similar listed company, or you've calculated that multiple, and we are now going to adjust for these differences. Now, I want you to think about it logically. If we are performing a valuation using PE multiples, how do we value our company? By taking our maintainable earnings and multiplying by the adjusted PE multiple. So if the company that we are valuing is more risky, then the multiple should be adjusted downwards. So if the company is more risky, the value of the company should then be lower. So it makes sense that the multiple must be adjusted downwards, because if we adjust the multiple downwards, the value will then decrease. And the opposite is obviously also applicable. If the company that we are valuing is less risky, then the multiple needs to be adjusted upwards. So if we adjust this multiple upwards, that is going to cause the value of the company to increase. And if a company is less risky, then its value should be higher. So please think about it logically when you are making these adjustments. And please note further, the listed company should be similar to the company that we are valuing so that we reduce the number of subjective adjustments. You'll see when we are making these adjustments, it can become quite subjective, and no two people are going to come up with exactly the same valuation. So we obviously want to limit the number of adjustments. So we find a listed company that is as similar as possible to the company that we are valuing. Then lastly, before we actually apply this to our question, please remember that the PE ratio is the inverse of the earnings yield. I discussed this with you when we looked at the analysis and interpretation of financial and non-financial information. And I said the same thing then. To avoid confusion, it is recommended that you focus on the PE multiple only. If an earnings yield percentage is given, you should convert it into a PE multiple as follows. Just take 1, divide by the earnings yield percentage, and you'll get your PE multiple. But we work with PE multiples. We don't work with an earnings yield. Now let's go back to the example that we are currently looking at. In this example, we were told that the trailing or the historic PE multiple for a similar listed company is 12. So you don't have to perform the calculation. We have the multiple of a similar listed company. So that is now my starting point. The multiple of the similar listed company is 12, and we are now going to adjust for the entity level differences. Now please note you need to study this list. And as you go through the list, you're going to consider whether there's a difference between the company that we are valuing and the similar listed company. If there's a difference, you'll adjust for it. If there's no difference, you ignore. And please note, linked to that, you can only adjust for known differences. So don't just adjust for things that you assume are differences. You only adjust for something if you know for a fact that there's a difference between the company you are valuing and the similar listed company. So the first adjustment that we look at is in terms of the level of gearing or the level of borrowing. Now, if a company has more debt in their capital structure, they are then more risky. So if we are looking at multiples, we know if the company is more risky, that means I need to decrease the multiple. Now, we weren't given any information about gearing or the level of borrowing in this question, so we can't adjust for that difference in this question. The next difference that we need to consider is the level of competition. So, for example, the one company might have more competition than the other company. Now remember, again, think about this logically. The company that faces more competition is going to be exposed to higher risk, and if risk is higher, the multiple is then reduced. Obviously, the inverse is also true. If a company is exposed to less competition, they will be less risky, and then you need to increase the multiple. So I'm just focusing on the one side, but obviously the inverse is also true. And once again, in this question, we were not given any information about the level of competition, so we can't adjust for this difference because we only adjust for known differences. We then need to consider the relative age of non-current assets. And a company that has older assets is going to be exposed to higher risk because those assets are going to need to be replaced in the future, and if they aren't replaced, the company then isn't keeping up to date with all the changes in technology, and the competition is going to leave them behind. The inverse is also true. If you have newer assets, you are then less risky. So a company with older assets is going to be more risky, and if the company is more risky, we need to decrease our multiple. If they have newer assets, they're less risky, and we then increase the multiple. Once again, we were not given any information relating to the age of non-current assets, so we can't adjust for this in our question. We then look at country risk. Now, guys, remember, country risk is the risk associated to investing in a foreign country. So if both of the companies aren't investing in foreign countries, then they won't be exposed to country risk. But if the one is investing in foreign countries, they will be exposed to country risk. If they are exposed to country risk, that means the risk of the company is higher, and if the risk of the company is higher, the multiple needs to be reduced. Again, in our question, we were not given any information about either Clarity Furnishers or the similar listed company investing in another country, so we can't adjust for country risk. Next, we need to look at the relative size of the entities, and please note smaller companies have a much higher risk of company failure than a larger company. So smaller companies are exposed to more risk, and if they're exposed to more risk, we decrease the multiple. Now, this is a difference that we can adjust for in our question, because if you go back to the information that we were provided with, we were told that Clarity Furnishers is a small family-run business, and we are using the PE multiple of a similar listed company. So a listed company is not going to be a small family-run business. So this is a difference we should definitely adjust for. Clarity Furnishers is smaller. Because they are smaller, they are exposed to more risk of business failure, so we therefore need to decrease the multiple. So you can see this in our solution. Clarity Furnishers is smaller than the similar listed company, so we reduce the multiple. Now, I haven't put numbers to my calculation, but I recommend that you do put numbers to your calculation, and you always just adjust by 1. So if this is going to reduce the PE multiple, I'm just going to decrease the multiple by 1. Please note, the mark is awarded for you correctly applying the principle. So if you've identified that the company we are valuing is more risky because they are smaller, you know that that needs to decrease the multiple. So as long as you decrease the multiple, you'll be awarded the mark. If you decrease by 1 or if you decrease by 2, you will still get the mark. So it's a consequential mark for applying the principle correctly. But please be reasonable. Don't reduce it by 10, for example. The next difference we need to consider is access to finance. And if a company has limited access to finance, that makes them more risky, and again, that means we decrease the multiple. Now, this is also a difference that we can adjust for, because the one company, Clarity Furnishers, is a Pty limited, so it's not listed, meaning that they have limited access to finance. On the other hand, we are using a multiple of a similar listed company. If the company is listed, they have easier access to finance. It's easy for them to raise new equity finance. They can just issue new shares. It's also easier for them to obtain more debt finance than it is for a small Pty limited. So in our case here, we will also be able to make this adjustment. So because Clarity is not listed, they have limited access to finance, meaning that they are more risky, so we are going to reduce the multiple. And once again, I'm just going to reduce by 1. The next difference that we need to consider is reliance on a small number of key employees. And if we have a company that is reliant or dependent on a very small number of key employees, that increases their risk. Because if one of those employees leave, that could have disastrous effects for the company. Whereas on the other hand, if they're not only reliant on a small number of employees, but they have a large number of employees, if one leaves, it's not the end of the world. So normally when we have a smaller company or a very small Pty limited, we will find that they are reliant on a very small number of key employees. That obviously increases their risk, meaning again we will decrease the multiple. And that is also definitely applicable in this question because Clarity Furnishers is a small family-run business. We can see the brothers are involved. They're the only two directors, so they are the two key employees. So that is definitely a negative factor that we need to take into account. So they are reliant on a small number of key employees. Because that increases the risk of the company, we need to reduce the multiple. Once again, I'm reducing by 1. We then need to consider the diversity of their product ranges. If a company has a very limited product range, so for example, they only sell 1 or 2 different products, that is going to increase the risk of the company. Why does it increase the risk? Because if demand for those products deteriorates, that will have serious consequences for the company. On the other hand, if you have a very wide product range, that decreases your risk, because if demand for one of the products decreases, it won't necessarily have such a big impact on the company. So if they have a limited product range or a small product range, that increases their risk, and we will decrease the multiple. In this question, we were not told anything about the product ranges of Clarity and also the product ranges of the similar listed company, so we can't make any adjustments. Then lastly, under business and financial risk, you need to consider any other specific differences that are mentioned in the question. So go through the question. If they highlight any differences between the two companies, make that adjustment to your multiple. Then lastly, we need to adjust for differences in future growth expectations. If the company is expected to have very good growth in the future, they will be less risky, and if they are less risky, we increase the multiple. On the other hand, if the company has poor growth expectations, that is obviously going to increase their risk, meaning that we will decrease the multiple. Now, in our example, we were given information about the growth prospects. You can see over here, despite a general decline in the furniture manufacturing industry, so the industry as a whole is actually declining, the earnings of Clarity are expected to grow by 9% per annum for the next 5 years because they have lucrative government contracts. So, Clarity Furnishers has better growth prospects than the industry. So if we are using the PE multiple of a similar listed company, we can only assume that that company's growth prospects are the same as the industry unless we are told otherwise. So Clarity has better future growth prospects than the similar listed company, meaning that they are less risky, and if they are less risky, we are going to increase our multiple. So Clarity has higher expected growth than the industry, so we will increase our multiple, and in this case again, I'm just going to increase by 1. Okay, make it clear that it's positive or negative. We have then completed step 2 of the calculation, and we have our adjusted PE multiple. So in step 1, we calculated our maintainable earnings. In step 2, we've calculated the adjusted PE multiple, and we can now move on to step 3, where we are going to wrap everything up and calculate our value. Once again, go back to the steps that I provided you with in the lecture notes. When we calculate the value, we take our maintainable earnings from step 1, and we multiply that by our adjusted PE multiple from step 2. And that is going to give us the market value of our business operations. So let's perform that calculation first. Take your maintainable earnings from step 1, multiply by your adjusted PE multiple from step 2, and get the value of your business operations. This then gives me the value of equity. How do I know that it gives me the value of equity? Because I'm performing this valuation using PE multiples. And how do I calculate a PE multiple? The PE multiple is the value of equity divided by your earnings. So when I multiply this out, it gives me the value of equity. However, please note, when we calculated our maintainable earnings, we excluded any income from non-operating assets because we said we were going to value those assets separately. So that's the next step to my calculation. Now I need to bring in the value of any non-operating assets which were excluded from my calculation of maintainable earnings. After I take that into account, I then have the fair market value of equity for this company. So what was the value of our non-operating assets? We were told in note 1 that the listed investment has a fair market value of 180,000 Rand on the 30th of June 20x6. So that has already been valued. You can then just include this in your calculation. So this is the listed investment, and that then gives me the fair market value of all of the equity of this company. Now that we've calculated the fair market value of equity, we need to adjust for owner level or shareholder premiums and discounts. So you'll remember at the start of this lecture, in addition to entity level premiums and discounts, we also have owner level or shareholder premiums and discounts that we need to consider. And these adjustments are made to the final market value of equity. So now that we have calculated the final market value of equity, we now need to consider these shareholder or owner level premiums and discounts. Let's first discuss a control premium. A control premium is a percentage that we add to the value of a non-controlling interest to reflect the powers of control. Now, please note, if you are the controlling shareholder in a company, or if you are buying a controlling interest in a company, there are certain advantages in having a controlling interest. You can make policy and strategic decisions. You can influence remuneration policies. You can revise the memorandum of incorporation and the company rules. And you can also control the dividend policy of the company. So these are the powers or the benefits of having a controlling interest in a company. So if you are buying a controlling interest in a company, you need to be prepared to pay more for that because you have these powers of control or the advantages of control. So that is why we add a percentage to the value that we have calculated, because we need to take into account that if you are the controlling shareholder, you have the benefit of control, you have all of these advantages, and you are going to pay more for that. So please note the percentage must be added. How much do you add? Once again, this is a consequential mark for applying the principle correctly. However, if you want a guide, you can add a control premium of anything between 15 and 25%. All right, so let's see how this is going to work in our example. First, you need to ask yourself, are we valuing a controlling interest or a non-controlling interest? So that's the first question I want you to ask yourself. Now go back to the information provided. We saw that when John retires, he's going to sell his shares to Jacob, meaning Jacob will then hold 100% of the shares in the company. So we said this is a majority valuation. So we are valuing a controlling interest. I've answered the first question. Let's actually write these questions down so that you don't forget. So with a control premium, the first question that you ask yourself is, are you valuing a controlling interest? So in our example, we said, yes, we are valuing a controlling interest. The next question that you need to ask is, does the value calculated reflect control? So these are the two questions we ask ourselves. So let's look at question 2. Does the value calculated reflect control? What do I mean? This is the value I've calculated over here. Does that value reflect control or not? And you were actually told this in the question. If you go back to where they gave us the PE multiple of the similar listed company, we were told that this PE multiple of 12 does not reflect a controlling shareholding. And that means that the value that we've calculated over here does not reflect control. Now, please note, if the question is silent, you can assume that this value does not reflect control. Why am I making that assumption? Because I'm using the PE multiple of a similar listed company. And with a listed company, chances are you are not going to have one controlling shareholder. With a listed company, you are going to have many minority shareholders. So this value does not reflect control. So please read the question carefully. If you are specifically told whether the multiple reflects control or not, then obviously do what you are told. But if the question is silent, it's safe to assume that the value does not reflect control because the PE multiple of the similar listed company should not normally reflect control. So I've answered the two questions now. The first question is, are we valuing a controlling interest? Yes, we are. And does the value calculated reflect control? No, it doesn't. So we now have a problem. We are valuing a controlling interest, but the value we calculated does not reflect control. And that means we need to add a control premium, because by adding the control premium, we will then calculate a value that does reflect control. And we want the value to reflect control because we are valuing a controlling interest. So you can see we then add a control premium. In this example, I'm using 20%, but remember, here's the range. You can use anything between 15 and 25%. So add your control premium. Why am I adding a control premium? Because Jacob is going to be the controlling shareholder after the sale, and the comparable PE multiple does not reflect control. So this value over here does not reflect control. However, Jacob is going to be the controlling shareholder, so he must be prepared to pay more for the benefits or the powers of control. So we add a control premium. This is then the value that reflects control. Please note, if we were told that the PE multiple of the similar listed company does reflect control, then this value that we've calculated above will already be the value of a controlling interest. So then you should not add a control premium, because then you'll be double accounting for it. So if this value already reflects control, don't add the control premium. However, because the value does not reflect control, and Jacob is going to be the controlling shareholder, I must add a control premium. Then the next owner level or shareholder premium or discount that we need to discuss is the minority discount. And this is a percentage that is deducted from the value of a controlling interest to reflect lack of control. Now, obviously, you can't have both a control premium and a minority discount in a question. You either have one or the other. Either you're valuing a controlling interest or you're not valuing a controlling interest, okay? It can't be both. So when we don't have a controlling interest, we deduct a minority discount. And just below you can see the guide. You can deduct anything between 15 and 20%. So obviously the minority discount is not going to be applicable in our question because we are valuing a controlling interest. So you can see in our solution, Jacob Clarity will be the controlling shareholder after the sale, so we don't have a minority discount. Now I just want to go back to something whilst we are still here. When we first looked at earnings multiples, we discussed where this method can be used. And I said to you that this method is preferred for a majority valuation, so it's better to use this method when we are valuing a controlling interest. However, we can use this method for a minority valuation by adjusting for owner level or shareholder differences. So if the value you have calculated reflects control, but you are valuing a minority interest, you should then deduct a minority discount. Then after considering the minority discount, we then need to consider a marketability discount. And this is a percentage that is deducted from the value of a shareholding to reflect the share's lack of liquidity. So in other words, if the shares are more difficult to sell, you should deduct a marketability discount. So obviously, if you are valuing an unlisted or a private company, you should then deduct a marketability discount because it's more difficult to sell the shares in an unlisted or a private company compared to a listed company. It is also easier to sell a controlling interest in a private company than a minority share. So if we have a bakery, it's much easier to find a buyer for the entire bakery than it is to find someone who's prepared to buy 10% of the shares in that bakery. So these things will affect the liquidity of the shares in the company. And if it's more difficult to sell the shares in a company, we should deduct a marketability discount. Once again, I have included the ranges just below. You can deduct anything between 5 and 15%. So if we look at our example, we are valuing a Pty Limited. So because the company is private and it's not listed, the shares are more difficult to sell, so we should deduct a marketability discount. And I'm just deducting a discount of 5%. Then the last type of owner level or shareholder premium or discount that we need to consider is a BEE lock-in discount. Now guys, BEE structures normally have clauses that restrict the transferability of shares for a certain period. And if you see something like that in a question, a lock-in discount must be deducted from the value of the shareholding. Now this is not very common. I have never seen it come up in a question before. But if you do see anything in terms of a BEE structure where shares are not allowed to be transferred for a period of time, please deduct a BEE lock-in discount. And you can see the ranges also just below. You can deduct anything between 9 and 15%. Then before we move on, just as a recap, please note the differences between the two types of adjustments. First, we had entity level premiums and discounts, and these adjustments were made to the multiple. Then we have owner level or shareholder premiums and discounts, and these adjustments were made to the final market value of equity. Make sure that you take the adjustments into account in the correct place in your calculation, otherwise you will not score the marks. Then let's go back to the framework or the steps that I provided you with. After calculating the final market value of equity, we then took all of our owner level or our shareholder premiums and discounts into account. We considered a control premium, a minority discount, a marketability discount, and a BEE lock-in discount. Then the only thing left for us to do is to multiply by the percentage shareholding that we are valuing. So in this example, we saw that each of the brothers owned 50% of the shares, and we also saw that John is going to retire and he wants to sell his shares to Jacob. So Jacob is going to buy John's 50% shareholding. So to wrap up this calculation, we just take our final value, we multiply by 50% so that we can see what John should pay for Jacob's 50% interest.